Since 2009, the American economy has split into two vastly different realities, creating a gap that statistics are only beginning to quantify. This is a visualization of the K-shaped economy. The top 0.01% has seen wealth move sharply upward, while the bottom 50% remains flat, holding only 3%. But the data suggests the machines are losing. A study out of Harvard University found that these advanced AI systems and the fund managers who use them are currently underperforming the broader market. The researchers found that these algorithms are too rigid. They follow a paint-by-numbers logic that leaves them unable to take the calculated risks necessary to capitalize on a shifting market. If the world's most powerful computers cannot calculate their way to wealth, it suggests that success in the market requires a different, less robotic approach. Instead of a static equation, the market operates on a rhythm, a pulse of momentum that changes as the economy evolves. Trading algorithms are built entirely on historical data. They are programmed to recognize a rhythm that has already occurred. But everything changes when a massive seminal event occurs, a sudden, unpredicted economic shift that completely breaks the existing pattern. When interest rates move or GDP growth surprises the market, the historical factors inside the black boxes become irrelevant. The formula stays the same, but the rhythm of the world has moved on. Machine learning fails during these transitions because it cannot predict the future. It can only react to the past after the break has already happened. We are living through one of these seminal events right now, the sudden, massive build-out of American AI infrastructure. For 3 years, Wall Street analysts repeatedly predicted that the era of American growth was ending. The physical facts tell a different story. The U.S. currently maintains more data centers than the rest of the world combined. This dominance is backed by exclusive patent rights and a surge in entrepreneurship, with the U.S. currently seeing a record number of new business starts. This growth is concentrated at the tip of the spear, the semiconductor companies manufacturing the actual silicon wafers required to run these new systems. The rapid expansion of these physical assets shifted how global capital is allocated, a change the rigid, historical algorithms failed to detect. This is where human observation becomes an edge. An investor can see these momentum shifts and have the conviction to stay with them while the algorithms are still recalibrating. Take a momentum stock like Marvell. A day trader attempting to time every peak and valley might see a 182% return, but an investor who simply bought and held through the volatility would have seen a return of over 300%. This strategy requires patience. You have to give quality companies an 18 to 36-month window to execute their business plans. Mathematically, human conviction over a multi-year horizon consistently outperforms the high-stress, high-frequency approach. Investing is never a matter of setting it and forgetting it, but you also don't need a supercomputer to build wealth. To move toward the top of the K-shaped economy, you must be willing to take calculated risks and own hard assets. The same demand for physical infrastructure that drove the AI boom is now fueling a commodity supercycle. This trend involves industrial materials and precious metals as the market's rhythm shifts toward tangible resources. Succeeding here means ignoring the daily noise and the panic headlines generated by Wall Street pundits. Find the companies setting the trends for the next decade. Invest with conviction and hold your ground.